What is up, people? It's time for another episode of Keeping It Real Estate here on KBeach Global Radio on the campus of Long Beach State. I am your host, the Real Estate Coach, joined every week and every Saturday morning at 10 a.m. by Frank Casarez, REO Frank.
Hey, buddy.
Alissa Alverez. You said hello before I introduced you.
I said bud.
You jumped. Alissa Alverez, the Mortgage Mistress.
Hey.
And to my left, Scotty Schang, the Dean of Homeownership University. We are bringing you
Stare down right now.
Our show is set up to empower and educate the consumers during the most important decision of their life, outside of that marriage thing. You know, well, that could be like 4 different decisions, really, for most people. But buying a home, I don't know where I'm going. Buying a home is tough, and it's big, and we want to be there to make sure that you've got the best possible information. Visual aids are everywhere. They're rampant today in the studio.
I didn't bring my own visual aid.
We're going to, Frank, you always bring a clipboard.
I brought a copy for you guys.
Nice, thanks.
All right. You guys can reach us at Keeping It Real Estate, keepingitre.com. I'm sorry. Choose a social media icon, your favorite one, and get a hold of us. Leave us some questions. Later in the show, we're going to do the mailbag segment, and we get that from our friends on Twitter, Facebook, YouTube, email, and, of course, you can leave a voicemail at 562-888-BEACH. Today, we're going to start off with the Mistress, and you are going to talk about a conventional alternative to FHA financing. Now, I'm assuming what that means is a conventional loan that offers a 3.5% down option.
Even better.
Even better? Shut the front door.
It's shut.
Man. So you're telling me there's a conventional loan out there that people can get and only put 3% down in a market where everybody wants 20% down?
Yes, the PMI companies are pretty much coming on board.
Who's PMI?
Private mortgage insurance companies.
Peter, Paul, and Mary or something. Yeah, I know.
So
you can't abbreviate anything around this guy.
No, this is an acronym-free zone.
Here are the nitty-gritties. We've got...
Who's nitty-gritty? Just kidding. Go ahead.
If you've got great credit, and I'm going to define this as 720 and above.
So who are we talking to? 3 people right now?
720 and above. This is for you. This is something that you'll
You sound like a commercial.
Yeah.
This is for you.
This is for you.
No, you'll want to at least look at this option, see if it makes sense for you, because it will be case-by-case scenario, but ultimately what's going to happen is...
Really? It always makes sense.
Not always.
It's the biggest no-brainer in the history.
History of mankind. Frank, you're killing me with this.
You have a 720? Okay, DTI.
Well, I
Can you just let her talk, Scott? You're always interrupting.
She's got me confused.
Here's what you can do. Not only is it 0.5% lower down payment, but the mortgage insurance, the monthly mortgage insurance, is going to be less than what it is for FHA. So FHA right now, the annual mortgage insurance is 1.25%. Okay, it could be 1.15%. So not only are you putting less down, but your monthly payment will be lower now.
Who's backing this loan?
Conventional, so Fannie and Freddie.
Fannie and Freddie. Those two guys got a lot of money.
And the mortgage insurance company.
Upfront. No upfront.
And no upfront. That's the other one.
Well,
So FHA,
what's up front?
Your mortgage insurance is going to be broken down to 2 parts. Part 1 is a one-time upfront fee. Currently, that's 1.75% if you put 3.5 down. And the other part is your annual, which is the 1.25%. So you're paying both. Okay.
And the thing with the upfront is...
It gets financed into your loan.
Well, yeah, you can finance it into your loan, but then the catch is you're paying monthly mortgage insurance on the new balance, which includes the upfront mortgage insurance. So you're paying interest
on that amount.
The mortgage insurance.
So with this conventional program, not only is your annual less, but you don't have that upfront payment.
What's it called?
3% down conventional financing.
No.
It's got no
It's
fancy
just-
name. It's got no fancy name.
I want a fancy name. Let's make one up.
There are 2 loan programs out there. There are government loan programs and there are non-government loan programs.
Okay.
This is the non-government loan program. We're typically in
We got to call it something, don't we? Because everybody
Call
else
it
has
the-
cool
No, it's just
names for their loan
conventional
programs.
financing.
Up
Let's
front.
call it like
Call it Norm. I don't know. Call it whatever you want.
This is the Mistress
Norm!
Master Loan.
the Mistress Master Loan. That's it.
Yes.
Ladies and gentlemen, I want you to go to your mortgage broker right now and ask
That
for
is
the
such a
Mistress
loaded
Master Loan.
name. As if Mortgage Mistress wasn't loaded enough.
That's
Mistress Master.
That's right. I am the Mistress Master.
Whoopsh.
Where you get loans my way.
Oh my God.
You know what? Some things are you'll want to consider, because when you start getting into conventional financing, you are going to be tied to stricter guidelines than you with FHA.
Meaning
Pricing.
higher credit scores and more money in the bank.
Well,
and
more money in the bank. You need more reserves.
And you need 2 months
higher.
worth of reserves.
Mm-hmm.
Well, here's really the magic of this, and I don't know if this is a breaking it down. But
David
this is
Copperfield.
kind of the beauty of this. Up until really, really recently, private mortgage insurance had much more strict guidelines than conventional loan programs. So even though you could qualify for this conventional loan program, you couldn't get the mortgage insurance if you had less than 20% down. Mm-hmm. So if you had less than 20% down, in a lot of cases, you had to take FHA because it was even more restrictive. Until just recently, like weeks ago, the mortgage insurance companies have completely aligned with conventional underwriting guidelines. So now you don't have to qualify for mortgage insurance and the loan.
Which is what you were doing.
Which is what you do with FHA. If you qualify for an FHA loan, you automatically qualify for the mortgage insurance. So what happened is now if you qualify for conventional financing, and you have a 720 credit score,
right,
then you automatically qualify for
760.
the mortgage insurance, and it just makes it so much easier. It's pretty big news.
Yeah,
Did
and
you press record,
it's
Scott?
big
Yes, I
news,
did.
especially for people who are looking at condos. Because one of the challenges, as we've been saying, is that FHA, there aren't very many FHA-approved condos nowadays, so this is
Right.
a possible alternative. Now, just know that
conventional funding.
by looking at condos, your pricing is going to be more expensive simply because you are now
More risk.
open to stricter guidelines with conventional financing.
But
And
you
you're
don't need the
only
whole
putting-
homeowners thing.
Well, you're only putting 3% down. We're still going to be doing what we call the HOA.
It's almost
certification.
Yeah, but you don't
Well,
need it. It's not a requirement,
What
right?
needs to
Frank
be
mentioned
FHA.
last week was spot approvals on FHA, and in conventional you can
That's what you can.
conventional you can approve condominiums on a case by case basis. So it makes it a little bit easier.
They fill out a packet that we send them and a questionnaire.
Why are people who back conventional loans not concerned about HOAs, but the government-backed loans are concerned about HOAs?
No, they still are, and they still have
There's
the same
actually an approval
qualifying.
list,
They
yeah.
still have the same approval guidelines and things like that. FHA just chose to mitigate their risk in a different way. So they're just a little bit more strict.
Does everybody have this loan?
Yeah.
Can any mortgage
because
broker, lender,
the
banker?
mortgage insurance companies have now come on board, and they are now aligned, like Scott was saying. with-
So it's a blanket.
Well, actually,
to-
what we have found is because of at our
investor
company
overlays?
we have different relationships with mortgage insurance companies. So if a lender says they can't do it, they don't have the right relationships with mortgage insurance companies. So I do know that there are some mortgage insurance companies that aren't willing to take that risk because they don't trust the lender as much. Well, that's a bad way to put it, but they don't have enough experience.
But
with
it's the
them.
truth.
But yeah,
There's no history.
because it's really about trust. You have to trust that the loans that you're delivering are low risk loans and that they've been underwritten properly. So there's a relationship there.
And PMI companies are really stickler on this because they're going out. They're almost like an endangered.
Well, because
species
most of them
right
went
now.
out of business.
Yeah, they're endangered
because they're the
species.
ones that paid out all the insurance costs. Now, there's.
Are you breaking
even
it down,
better-
Scott?
No, I'm not breaking it down. But I wanted to.
Someone's got to break it down. It's time to break it down.
I wanted to build on Alissa's.
No, we're not building. We're breaking.
All right. Well, okay. This is partially we're breaking a little bit down.
Okay.
3%. 3% is better than FHA.
5%.
If you put 5% down, the mortgage insurance is half as much as at 3%.
Ooh.
Okay.
Nugget.
And
57%.
if you can,
Nugget.
well, we won't break it further, so
Good.
we won't build any.
No,
further.
that wasn't
Broke.
expanding. That was nugget. You were giving
That
a
was
nugget.
nugget.
5%
Rolled
down.
a nugget.
Although you can get 3%, do the 5% because you save
Exactly.
some cash.
Tons.
You're saving a chunk of cash.